The word of the day is materiality. We throw that word around a lot in this class, but it's actually a word you actually need to know. You need to know really well. We recall the definition of materiality as an amount that's large enough that a user of the financial statements would care about it. But how do we determine what a user of the financial statements would care about? Well, we could look at quantitative factors like total assets, total revenue, total gross profit. We're going to look at all those quantitative factors. And likely they're not all going to say the same thing. So we're going to have to put together an estimate. Materiality isn't going to be a range. We're not going to say we care about things between 1 and 300,000. We're going to have to pick a point. And so, but these are going to give us ranges. So we might say 1 to 3% of total assets. So how do you pick the amount? Well, you're going to look at the engagement risk, what the users are expecting in a high risk setting where the firm is facing high engagement risk. They're likely going to pick a lower range of the materiality. So that's where the qualitative will help inform the quantitative. And so if it's a first year client, they've got a lot of control weaknesses, management turnover, a lot of market pressure, that's going to make us assume that a lower risk or a lower risk is desirable. So when there's a lower risk, there's a lower materiality. But it doesn't end there. Our thought process has to include what we do with this. And this is where the math comes in really. We're going to add up materiality at the financial statement level, but we need to figure out, well, what does this mean at the account level? Because even if I said for the financial statements as a whole, we'll accept $1 million error or misstatement, that doesn't mean accounts receivable could be overstated by $1 million, because on that one account, it would be too significant. So we'll actually determine a tolerable misstatement for each individual account. Now, if we constrain ourselves to materiality, that would mean we would have a really tight audit. So what we actually do is we would allocate more materiality than is the total. So for example, we might allocate $250,000 to revenue, $250,000 to some expenses. On the balance sheet, we might allocate 100,000 to cash, 300,000 to receivables, 200,000. The point is they're going to add up to more than $1 million. And so does that mean we've made a mistake? No, because we know we're not going to use all the tolerable misstatement in every account. And so what we are going to do is when we identify misstatements, we're going to have two thresholds. At the account level, is it below the threshold? And are the totals still less than materiality? That's where you see the phrase, are the individual accounts individually or collectively? That collectively is where we add it up. And so now I've said identified misstatements, but there could still be problems, even if the identified misstatements are less than tolerable, because if we do sampling, we're going to have to project. We're going to have some sampling allowance to that, the likelihood that we've just got an unlucky sample. So identified misstatements plus projected misstatements plus the sampling allowance has to be less than the tolerable misstatements. That's really going to become clear when you look at how you do sampling. We also need to recognize some years we start having already used up some of our materiality. For example, if ending inventory in 2019 was overstated, then beginning inventory in 2020 is also overstated because those numbers carry forward. Now, that's balance sheet items it's going to carry forward on. It does not carry forward on income statement items because those reset. And so you'd want to look at that as when you look at the prior year audit, you'd go through that and see what issues remain unresolved. And I would conclude there are problems if the identified misstatement is near materiality, but below. In other words, the goal isn't to get as close to materiality as we can. So if we were willing to accept $1 million in errors, if our best estimate, sampling allowance, everything was 999,000, we are technically below materiality, and we could technically say this, but that wouldn't feel right. That wouldn't feel like a profession. We wouldn't have any wiggle room if there was anything we found, because if we find something in the future, we will then have exceeded materiality. So we want to be below in case something immaterial comes up that won't push us over the collective materiality threshold. So we spent a lot of time thinking about materiality. It is a big idea. It is one you need to know. Be comfortable with it.